Today, inflation temporary, a market update for the 12th of October 2021. Hello again, it's Martin North from Digital Finance Analytics, world latest post covering finance and property news with a distinctively Australian flavour. In today's show, we look at the US markets on Columbia Day, when many markets were actually closed, comments from Jamie Dimon as Bitcoin rises higher, and views from analysts on future growth and inflation, and whether stagflation fears will start to fade. And just before I start, a quick reminder that I'll be joined on my live show tonight by Investment Manager Tony Locantro from Alto Capital at 8 p.m. Sydney time, and that's a perfect opportunity to ask a question live. So just quickly, US stocks gave up early gains to finish lower on Monday, slumping as investors await the kickoff of the earnings season, as well as economic data due later this week on inflation and retail sales. The Dow Jones Industrial Average fell 0.72% to 34,497. The S&P 500 lost 0.7% to 4,361, and the Nasdaq was down 0.64% to 14,486. And Jamie Dimon, the Chief Executive Officer at JP Chase, said again that personally I think Bitcoin is worthless, reiterating his past comments, but the banking giant will offer its clients exposure to Bitcoin, he said, while briefly speaking at the annual Institute of International Finance event. Our clients are adults. They disagree. That's what makes markets, he said. So if they want to have access to buy yourself Bitcoin, we can't custody it, but we can certainly give them legitimate, as clean as possible access. JP Morgan started giving its wealth management clients access to crypto funds in July. And in fact, Bitcoin was up 3.54% on Monday, hitting 57,500, and most recently is just below that. That's a 15.6% gain over the past 7 days. And Ether was trading at 3,557, up 1% over the past 24 hours. The crypto community on Twitter highlighted Bitcoin's latest bullish levels against Dimon's past comments. No surprise there, of course, because this, as I've said before, is more religion than anything else. And then Goldman Sachs is becoming increasingly pessimistic more broadly about the US economy as coronavirus support from the government phases out and consumer spending remains on an uncertain path. Over the weekend, the Wall Street Bank downgraded its forecast for America's economic growth, which is closely monitored by the investment community. Goldman Sachs now expects the economy to expand by 5.6% this year, compared to a previous estimate of 5.7%. And in 2022, they project growth of 4%, down from 4.4%. Actually, that's the second time Goldman Sachs has revised its 2021 forecast lower in 2 months. The bank's team of economists said two main factors drove the change in the outlook. One is that COVID-19 relief programs are set to wind down significantly through to the end of the year, eliminating a source of income for some households. The other concern is that consumers are not doling out enough money in services to compensate for a drop in spending on goods. Consumers' service spending will need to recover quickly to offset a decline in goods spending as the latter normalizes from its current elevated level, Goldman Sachs told its clients. This will likely prove challenging while COVID cases remain elevated, since many people still feel at least somewhat uncomfortable engaging in many activities that were routine prior to the pandemic. And it pointed to movie theatre attendance as one sticking point. James Bond's film No Time to Die brought in $56 million in North American box office takes over the weekend. That was a muted performance for the Bond brand. Goldman Sachs also thinks spending could decline as people continue to work from home, encouraging them to prepare their own lunches instead of popping into local restaurants. But then, for another view, Bank of America said It's been encouraged by spending trends gleaned from US credit and debit card data. We think the recent drop in cases has helped ease COVID concerns, said Bank of America research. The bank found that spending at daycare centres in September was 52% above last year's levels and only 13% below the same period in 2019, which it called an encouraging sign. And it also observed that spending on travel and entertainment is improving, though gains haven't been felt evenly across the country. People have been significantly more willing to splurge on entertainment in Florida than in states like New York and Pennsylvania. So the question, of course, is, and it's the big picture question, what's happening with COVID-19 in the US? And is it going to look brighter as new infections and hospitalizations decline? Hopefully, it's going to continue to go in that trajectory downward, Dr. Fauci said. But the country is still reporting about 95,000 new infections daily, which Fauci says is way too high. That's making it difficult for economists to map out the way forward for America's economy. And then, of course, there's the old question of inflation. Stagflation fears may be rising, but strategists at some of Wall Street's biggest banks say it's a good time to buy the dip in stocks, says Bloomberg. Despite near-term uncertainty, we expect the equity market will continue to rally as investors gain confidence that the current pace of inflation is transitory, Goldman Sachs wrote in the note. Strategist JP Chase concurred, writing that stagflation fears will start to fade. Jitters over surging prices and concerns that the post-pandemic recovery is now past its peak dragged the S&P 500 index lower over September after almost a year without a correction of that magnitude. Persistent supply bottlenecks, along with a slowdown in China, have raised doubts about whether stock valuations can be stretched any further. A Deutsche Bank AG survey of market professionals suggested that the majority of them see at least another 5% pullback in equities by the end of the year. That is based on the consensus that some sort of stagflation will be there going ahead. But they said, we believe this dip will provide a good buying opportunity, as 5% pullbacks usually have been in the past, Goldman said. We finally got some weakness after 330 days of no greater than 5% pullbacks, but we don't expect it to last and advise to buy into the dip, said JP Morgan strategists. Bullish calls from JP Morgan and Goldman add to an increasing number of voices saying that the current spike in consumer prices, largely fueled by a jump in energy costs, will be temporary. The surge in energy prices will slow growth, but in our view is not sufficient to cause recession, UBS Global Wealth Management strategists wrote in a note on Monday. Energy prices are likely to stabilise or moderate through next year, and they also added that central banks will likely look through higher energy prices as opposed to overreacting. Well, I have to say that the evidence is much more contrasty and mixed to my mind, and if I look at rising prices across the board, it seems to me that inflation is indeed getting embedded, and if inflation does get embedded, then that means two things. One, higher interest rates sooner than everybody expects, and there are signals both from the UK now and other places too that rates will rise sooner. And the second, of course, is with growth still very low despite all the stimulus, the chances are that stagflation is still on the cards. I guess it's just a matter of where you are and how you see things. But I do think that some of these analysts in some of those big financial firms have a vested interest in talking the market higher. And I sometimes wonder how objective their analysis really proves to be. Now, if you're buying your home in Sydney's contentious market, you don't need to stand alone. This is the time you need to have Edwin Almeida from Ribbon Property Consultants standing alongside you. Buying a property is both challenging and adversarial. The vendor has a professional on their side. Emotions run high, Price discovery and price transparency are hard to find. And then there's the wasted time and financial investments that you make. Edwin understands your needs, so why not engage a licensed professional to stand alongside you? With RPC, you know you have experience, knowledge, and master negotiators looking after your best interests. So shoot Ribbon an email at info@ribbonproperty.com.au, and if you use the promo code DFAWTW/Martin, you can get a 10% discount offer. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.